Your child's dream could be to become a rocket scientist or the next Indian Idol. You never know what fuels their imagination and what they plan for themselves. As a parent, what is the best you could do? You can back their dreams and provide financial support whenever needed, right? Will ready-made children education plan help to secure the funds for your child's future? Is buying Max Life Shiksha Plus Super a good decision? In this video, let us review Max Life Shiksha Super Plus plan and figure out whether this plan can fund your child's dream. Welcome to holisticinvestment.in. Max Life Shiksha Plus Super Plan is a unit-linked non-participating individual life insurance plan. The main features are it has option to choose your policy term and premium paying term as per your need. Guaranteed loyalty addition increase your fund value. The plan offers comprehensive life insurance coverage including family income benefit and funding of premium in case of death. 2 investment strategies and 8 fund options are available. Next, let us look at the benefits in detail. First, death benefit. In case of death of life insured, the following 3 benefits are available. First, lump sum benefit, higher of sum assured or 105% of premiums paid or 0.5 into policy term into annualized premium. Next, family income benefit, an amount equal to 10% of sum assured will be paid on each policy anniversary till the end of the policy term, but not exceeding 10 such installment. Next, funding of premium. The company will fund all outstanding premium payable and the fund value will be paid on maturity. Next, maturity benefit. Fund value as on date of maturity is payable provided settlement option has not been exercised. Next, guaranteed loyalty addition. 0.2% of fund value shall be added to the fund at the end of every policy year starting from 11th policy year. Next, we shall look at the investment strategies and fund options. You may choose to invest in the following 8 funds available in this plan. The risk profile differs based on the asset allocation. You need to choose the funds based on your risk profile. Alternatively, you may opt for either systematic transfer plan or dynamic fund allocation strategy. Systematic transfer plan. First, units shall be allocated to the secure fund and thereafter on each month anniversary, a fixed value shall be switched to growth super fund. Dynamic fund allocation. Your money will be split between 2 funds, growth and secure, based on how many years you have until maturity. Next, we shall look at the various charges under Max Life Shiksha Plus Super Plan. First, premium allocation charge. It is expressed as a percent of premium received. It ranges from 3% to 5%. It depends on the premium paying term and policy year. Next, fund management charge. It is based on the fund chosen. It ranges from 0.9% to 1.25%. Next, policy administration charge. For annual mode, 0.32% per annum. For non-annual mode, 0.22% per annum per month. Compounding at 5% per annum from the 6th policy year onwards up to a maximum of rupees 500 per month. Next, mortality charge. It is based on your age at the time you buy the policy and it is the same price for both men and women. Next, surrender and discontinuance charge. It is calculated based on the policy's duration and premium amount and it will be deducted from the fund value. Switching charge. A maximum of 12 switches are allowed in a policy year and all are free of charges. Next, premium redirection charge. A maximum of 6 premium redirections are allowed in a policy year and all are free of charge. Next, partial withdrawal charge. After the first 5 policy years, a maximum of 2 partial withdrawals are allowed in a policy year and are free of any charge. Inference from the charges. The premium paid by you doesn't get invested fully in the chosen fund. The aforesaid charges are deducted and the net premium goes into the fund. Over a period of time, these charges are overhead costs to investment. This will affect the investment returns. Other market-linked products don't levy these kinds of charges. Next, we shall discuss the advantages and disadvantages of Max Life Shiksha Plus Super Plan. Advantages. You have a choice of 8 funds and 2 investment strategies. Apart from lump sum death benefit, there is funding of premium and monthly income benefit. Unlimited free switches, 6 premium redirection and 2 partial withdrawals are allowed in the plan. Settlement option can be exercised during maturity. Option to decrease the premium up to 50% of the original annualized premium. Next, disadvantages. No liquidity in the first 5 years of the policy. After deducting all the charges, only the net premium will be invested. The loan option is not available. During the settlement period, the investor should bear the investment risk. Top-up premium option is not available under the plan. The return on investment plays a major role when selecting an investment product. The product that we invest in should yield an inflation-beating return in the long term. Let us check the internal rate of return of Max Life Shiksha Plus Super Plan using the figures given in the policy brochure. A 35-year-old male buys Max Life Shiksha Plus Super Plan for his 5-year-old child. The sum assured is Rs 7.5 lakhs. The policy term and the premium paying term are 15 years. The annualized premium is Rs 75,000. He receives the fund value at maturity. The mentioned rates of return, that is 4% per annum and 8% per annum, are just examples of what you might earn after deducting all charges. They are not guaranteed and could be higher or lower depending on how the investment perform in the future. At the 4% scenario, the final maturity value is 12.15 lakhs. IRR calculation for the 4% scenario results in 0.96%. This rate implies that the premium paid by you come back to your pocket without any value addition. At 8% scenario, the final maturity value is 17.02 lakhs. IRR calculation for the 8% scenario results in 5.02%. This rate is less than bank's fixed deposit rate. A market-linked product fetching a return lower than a debt instrument is not favorable for investors. In the long run, this affects your wealth accumulation process. Now let us compare other instrument returns with Max Life Shiksha Plus Super Plan. This will help you in arriving at informed decisions. For comparison purposes, let us assume the same figures as seen in the previous benefit illustration. With the same premium amount of Rs 75,000, let us work out some alternate investment options. For life cover, picking a pure term life insurance policy is the right choice. A pure term life insurance policy for a sum assured of Rs 7.5 lakhs would cost Rs 3,800. This leaves you with Rs 71,200 for investment. You can choose an investment vehicle as per your need. To illustrate the working of different asset classes, we have chosen two scenarios: ELSS for equity asset class and PPF for debt asset class. After paying pure term life insurance premium, the balance is invested either in PPF account or ELSS fund. The final maturity value under PPF investment is 19.31 lakhs. This is a tax-free amount. The IRR calculation for the pure term life insurance policy premium and PPF combo results in 6.50%. ELSS proceeds are subject to capital gains tax. Under ELSS fund, the pre-tax value is 29.72 lakhs. After capital gains tax payment, the final maturity value is 27.92 lakhs. The tax calculation is given here. IRR calculation for pure term life insurance premium and ELSS combo results in 10.71%. The rate of return from these alternate investments is higher than inflation. This ultimately helps to accumulate wealth in the long run. Max Life Shiksha Plus Super is a market-linked product but doesn't accelerate your wealth creation. Here is our final verdict on Max Life Shiksha Plus Super Plan. The plan invests only the net premium, that is, after deducting applicable charges, the premium gets invested in the funds of your choice. Fund choices may vary from debt, that is low risk, or balanced medium risk, or equity which is high risk. Based on personal risk appetite, you may choose any one or a combination of fund options. The return analysis reveals that potential returns is substantially low. Though it allows to invest in the market, it fetches less than a debt instrument return. High charges deplete the return in the long run. This can disrupt the dream of your child. Education cost doubles every 6 years. Ready-made children education policies may not keep up with the rising cost of education. Therefore, investing in instruments that can sustain inflation can help parents earn better returns. To navigate the intricate landscape of education finance, consult a finance professional. A detailed review of Max Life's Shiksha Plus Super Plan is available as a blog post in our website. The link is given in the description.
Hope you like this video. If you have any questions related to this or any other investment option or related to your financial goal, don't hesitate to book a free appointment with our financial planners. The link to the free booking is given in the description box below. Also, will you be interested to attend any insightful investment webinar? Then feel free to register for the upcoming enlightening investment webinar. It is completely free. The registration link for the upcoming webinar is also given in the description box. If you like this video, please give us thumbs up. Also, share it with your social circle. If you haven't subscribed our YouTube channel so far, please subscribe now.